we left off the other day talking about different types of loans, loan underwriting, how to do ratios, right? 28 and 36. And we said that FHA was 31 and 43. And we also said that VA was 41% gross, right? Gross to income. Just know that the FHA loan and the VA loan, the purpose of that is that you can get a little more loan amount for your income, but you're going to have to probably do a question on the 28 and 36. Now, if I remember the questions correctly, they're going to tell you the ratios, but somewhere in the back of your mind, just remember 28 without any consumer credit, 36 with consumer credit, okay? Just put that in the back of your head, but I believe that they're going to give you the ratios in the question, but I don't want to leave you out there to dry. So just heads up on that. All right. And what we're going to talk about now are government regulations on the new closing procedures. October of 2015, in September of 2015, we had a truth in lending estimate. We had a good faith estimate. We had all kinds of forms when you put a loan application in. And then what happened was in October of 2015, they changed that to consolidate these forms. Remember the CFPB? We talked about Consumer Financial Protection Bureau, and they consolidated all these forms. And what they did was they wrote in TILA is called the Truth in Lending Act, okay? But what they did was they said that in the Truth in Lending Act, we want to make sure that everybody understands the true cost of lending. What's their charges? How much are you going to charge for these things, right? So we can't, there are certain things that they have to disclose to you if they quote. Has anybody ever heard, if you're listening to the radio on regular radio and somebody reads a car ad and they say, no money down, and then at the end of the car ad, the guy's talking like a million miles a minute so that you can hardly hear what he's understanding, what he's saying. What he's giving you is details, and that's financial details. That's Truth in Lending Act. That's Regulation Z. They have to give you, if they quote a price, if they quote a number in the ad, how much down, how many months you have to pay, what number is the down payment, what's your interest rate. If they quote any of those, they have to give you the rest of the information, okay? And I'll show you a real life example of that once we get a little bit more into this. So this is all under the Truth in Lending Act. They have to give you the Regulation Z. So in the blue here, it says, must disclose all credit charges if a trigger term is used in the advertising. Trigger terms, right? If they say how much down, right, in dollars and cents, what's your interest rate? Anything that has a value, anything that has a dollar figure in it, including zero down, that's a value, okay? They have to give you all of these other credit charges. How many months? What's your APR? All of these things, right? So they can't quote specific numbers without an APR, all right? They have to give you that. What's your real cost? Are there any fees associated with it, right? So except for all non-loan items such as HOA fees and seller-paid closing costs. Your HOA fees are not going to have an APR on it. Your closing costs, your seller-paid closing costs are not going to have an APR on it, right? So we have this. We need to get this from the person who's offering the credit, all right? So there are 4 chief disclosures here, all right? The APR of the loan. How much is the annual percentage rate with the fees included? With the fees included. All the finance charges, right? The total number and amount of all the payments and the total amount financed. Those are disclosures. Those are things they have to tell us. So if they say zero down, well, when they say zero down, they better give me the rest of this information. This is part of it, okay? So the APR isn't the interest rate. APR is not the interest rate. All right, the APR is the full annual cost of credit. And it's typically a little higher than the interest rate. So let me show you what I'm talking about. If you, the CFPB is going to give you this home loan toolbook kit in the event that you're getting them your mortgage. You're supposed to give that to them. But let me show you the loan estimate form. You fill out your loan application. They have 72 hours to get you this loan estimate, okay? And this loan estimate is your cost of charges. So what they do here is they give you, we'll start at the top, application, fee, addresses, sales price, 30-year fixed loan, all right, loan ID and all of that, okay? Now this sample sheet comes right out of the CFPB. So again, this was done a bit ago, all right, but it's accurate. On this sheet, and some of you may have seen it if you closed on a house lately, your loan terms, how much are you going to take out on a loan? You're going to pay $180,000. That's what this says here. And then you're going to take out a loan for $162,000. And they quoted you a 3.875% rate, which you thought was pretty hunky-dory, right? That's all good. Looks better now, but back then. Well, that breaks out to $761.78. They used our interest rate chart, right? 30 years at 3.875. That's what times the factor of times 162. Now, does this thing have a prepayment penalty? Yes, they have to disclose that. If you pay off the loan during the first 2 years, you could pay $32.40. All right. Is there a balloon payment? No. Principal and interest for the first 7 years, right? Here's the payment for the monthly, an estimate. Now, keep in mind here, we're borrowing 90% on this loan, so we're going to have PMI for the first 7 years, and it tells us that right here, right? After that, our mortgage payment will go down for principal and interest because we don't have PMI. We got rid of it. Once we reach that 80% threshold, we can get rid of the PMI. Estimated taxes and insurance. This is, again, an estimate, property taxes and insurance. Estimated closing costs, when we see the next page, you'll see those. And then how much do the cash to close? How much do you think you're going to close? All right, we turn to the second page. We turn to the second page, and then all of a sudden we have some things that add up to this $8,000 here. The first thing is we're going to pay 1/4 point for our interest rate, right? Then we're going to pay an application fee of $300. Then we're going to pay an underwriting fee of $1,097. I have to disclose all of these things to you, right? I have to tell you. Then we're going to have services you can't shop for, an appraisal fee, a credit report fee, flood determination, things of that nature. You can't shop for those, you got to do them. And then services you can shop for. You can get a different pest inspector, you can get a different surveyor, right? Your title company could be different. So these things you might be able to get better or worse. So those are estimates. Up here on the second column, some other costs. You have recording fees, transfer taxes, which would be for the seller. Any prepaids, you're going to have to pay homeowners insurance, right? You're going to have to pay that in advance, right? When it's due, it's going to be due on the day. Prepaid interest, right? How much? Remember that interim interest? We have to pay that little bit of interest we talked about from the date of closing to the end of the month so that we can give it to the bank. So that's going to be here. 15 days from at 3.875. Now, we also are going to put money to start our escrow account, and they're going to collect that at closing. So 2 months, right? RESPA says 2 months. So some of our examples say more than that, but technically you can put 2 months homeowners insurance and 2 months property taxes in the escrow account, okay? So they'll collect that at closing. Title, your owner's insurance title policy, another $1,000. All right, add it all up, and here is where we're going to put the funds for the borrower, $18,000. You gave us $10,000 as a deposit. Estimated cash to close, $16,054. All right. Remember what I said, 3.875 on that first page? In 5 years, you're going to have paid principal, interest, mortgage, insurance, and loan costs $56,582, and $15,000 of your principal have gotten paid off. But here is the thing: your APR, your annual percentage rate, that's not 3.875, is it? No, when they add all of those fees in, they have to tell you what your annual percentage rate is really going to be. When all those fees are added in, your annual percentage rate is 4.274. That's almost 0.5 point more, right? Now, they have to give you that now. Before, they didn't have to tell you what that was. Now they do every time you get it on the third page. So the cost, your cost over the loan expressed as a rate. This is not your interest rate, but this is with all the fees in it. Remember, we had an underwriting fee, and we had a point that we had to pay, or a quarter point we had to pay. We had an application fee, all these things. So yes, they advertise 3,875, but when you get it after your fees, it's 4.274. And this is how it has to work. Okay, this is how it has to work. They have to give you these. Remember, we did a couple of problems that gave us the total interest over the life of the loan Tuesday night? Well, if we pay off this loan in 360 installments, we'll pay 69.45% of the payments will go. That is our total amount of interest that we're paying over the life of the loan. So we'll pay our loan off plus another 70% over the life of the loan. So this is your loan estimate. This is your loan estimate, okay? And then you have to confirm receipt, okay? So that's what it looks like. That's what the estimate looks like, but that's where they change it. That's how this changes. They have to give you this number. Now, another thing that we have to look at, let's say you're shopping and you're looking for a loan. And they advertise, and I'm on Rocket Mortgage Loan here, and this is today's loans. They advertise, let's go to purchase here. They're going to give you a 30-year fixed loan for 6,375 today, January 26, 2023. However, look at where your APR is, 6.672, because you have to pay almost $6,500 in points, 2.125 points to get the lower interest rate. Okay. Now, okay, Sam, they quoted me numbers in dollars. Now what? Well, let's look at the bottom here. On the very bottom of their ad, it says view legal disclosures. This is where they have to give you the Regulation Z. And it says here, it gives you an interest rate of 6,375 as the cost of 2.125 points paid at closing on a $300,000 mortgage. You would make a monthly payment of $1,871.61. Monthly payment does not include taxes and insurance premiums. The actual payment amount will be greater. Payment assumes to be a loan to value of 79.5%. So they have to give you all this information. What's it really going to cost you? Okay. And then all of these assumptions also. Credit score, what you can get to get it. If your score is under 720, you're not going to get that rate. You're going to get a higher rate. So all these things are there. Okay. And this is all part of their disclosures that they have to give you. All right. And then Rocket's really good about giving you answering all these questions also. So you can go out there and figure out how they're calculated, how is their personalized mortgage rate calculated, things of that nature. What's the difference between interest rate and APR? The interest rate is the percentage you pay to borrow money from a lender for a specific period of time. The APR, or the annual percentage rate, includes your interest rate plus additional fees, expenses associated with taking out your loan. So they're giving it to you. They're really good. If you ever want to go and get an explanation of what they do and how mortgages are figured out and the information for that, you can go to Rocket, today's mortgage rates at Rocket Mortgage. And just for the educational factor, they're pretty good at telling you that. And that's why I use this one, because they give you a lot of information. You don't go blindly out of this, right? All their different types of loans that if you wanted to, again, it's all here. If you're a VA loan, right? If you're a VA loan, no down payment loan option was created especially for qualified veteran service members and their spouses. No down payment at a lower interest rate. FHA loans. FHA loans are available for people with credit scores of 580 or higher. See how low that is, 580? If you have a pretty poor credit score, FHA might be the way to go. Because a commercial bank at 620, they were just telling you a 720 to get this rate, but FHA will insure it at 580. So if you got credit issues, that might be the way to go, right? At a lower interest rate. And then there's the jumbo loans, right? Jumbo loans are over, I want to say they're over 750,000 now. And again, 30-year jumbo loans fixed over 30 years. I'm going to see if they have it fixed rate. 30 years fixed rate. I want to see if they're talking about jumbos, how much they are now. They change all the time. $950,000 mortgage, you would take monthly payments of $55.43. So it's up over $700,000 for a jumbo loan. You're going to rent if you're going to borrow that, right? So if you qualify, it's not a bad deal. All right. All right. Any questions on what I'm talking about? These are all the disclosures. These are Regulation Z disclosures. Okay. So they have to tell you this. If they quoted you something, a number, they have to give you the rest of the information. What's the true cost of borrowing? All right. What's the true cost of borrowing? And that's what they need to know. All right. So if they give you any of these, right, if they tell you any kind of number. So the APR is not the interest rate. The APR is full of annual cost of credit and typically higher than the interest rate. Typically higher than the interest rate. Okay. All right. So if you're looking at this, if I say, if my advertisement says low down payment, that's not a trigger term. There's no number in there, right? There's no number in there. But if I say only $2,000 down in my ad, what am I going to have? I got to give you the rest of the information, right? That's a trigger because I use the number here in the ad. If I say low monthly payment, there's no number there. No trigger. If I say your monthly payment is going to be $1,000 in my ad, what do I got to do? I got to give you the rest of the information, right? If I say zero down payment, same thing. It's a trigger term. I got to give you the rest of the information, all right? So if I have a number in there, that is a trigger term. I got to give you all of it, okay? So that's TILA. Moving on to RESPA, Real Estate Settlements Procedures Act, okay? So we have to disclose all the settlement charges. That was what the loan estimate was before, what I was doing. Not only was there truth in lending, because I had to show you Regulation Z, but that was all part of RESPA also. That you need to know what you're spending your money on, all right? And we're going to get into a little more depth in TILA and RESPA in chapter 21, but we'll get there, promise, all right? So they have to give you all the settlement charges in residential transactions. That was all of that stuff I gave you before in the loan standard. Lender laws standardize settlement of 1 to 4 family residential owner-occupied properties. They fall under RESPA, the Settlement Act. Residential properties, 1 to 4 family, okay? They got to give you that home loan toolkit. Remember I showed it to you just a minute ago, the green cover book, right? The home loan toolkit. If you're interested, it's in your Dropbox. You can go get it. There are fees that we talked about that they can't increase. Remember I said you can't shop for these? You can't change those? You can't increase them? Or well, once they say that you can't shop for them, they can't change those from the loan estimate to the end. Those are stuck, whatever they said. They can lower them, they can't add to them, okay? And their amount of advanced escrow is restricted. You're going to have to pay your escrow. Your homeowners association not your homeowners association due, I'm sorry. Your house insurance, when you close, it's due. You got to pay that at the closing. But then you also have to start your escrows for the next time it comes due. So they're only allowed to charge you 2 months of escrow taxes and 2 months of escrowed insurance, according to RESPA. They can't take more than that. They can't make you pay 10 months worth of future taxes. They can't make you do that. They can hold 2 months, and then every month they would add to that as they collected it. Kickbacks. Kickbacks to the real estate agent, kickbacks to anybody are prohibited under RESPA. I think I explained to you our company stopped giving us $50 a piece for every home warranty we sold because they thought it fell under RESPA as a kickback. So we couldn't collect it anymore. RESPA said you don't get paid for doing that, right? So we cannot. It prohibits referral fees. Okay. Okay, so in TRID, we have TILA, which is the Truth in Lending Act, which we talked about before, and we have RESPA, Real Estate Settlements Procedures Act. Put this together, and this is TRID, TILA-RESPA Integrated Disclosure. Okay, TILA-RESPA Integrated Disclosure. So we have lender laws, right, for transactions. I just showed you that loan estimate requirement. I showed you the loan estimate. That's what that was. And I said that you had to get it within 72 hours of making loan application. That's the rules. That's the law under TRID. Okay. You have to be given it 3 business days from when you applied. Right. And any lender denial, if they say you're not going to get it, it has to be in writing. That has to be in writing. And you have to get a proof of your credit report. Right? You have to get a reason why, and then you have to get proof of your credit report. Okay. So let's just take a look at that, just to make sure we understand it. And then we go to what we showed you before, was we have 3 days. We made a loan application, and we have 3 days to get this. Okay. This is our loan estimate. 3 days. That's what they have to give it to us. And we have to get all this detail. Now, I want you to see some stuff here. When it says these loan costs here, because they go directly to the bank, and these services you cannot shop for, they may not go up. From the loan estimate to the closing, those cannot go up. Now, if they find a way to go them down, that's fine. But when you go to closing, they're going to be the same unless they've changed, unless you've changed and they've found a different way to pay them. But those origination charges will be $1,802. Okay, they'll be $1,802. If I showed you this one on when we get there, origination charges on the closing is $1,802. They have to be the same. Okay, because you can't shop for them and they're charging them for you, so you can't go to closing and make more. Now, services you can shop for but are necessary to the closing. If you can shop for these can go up 10%. Okay. If you shop for them off of off of the bank's list of vendors, and you pick somebody else other than who they choose, they can go up 10%. If you choose somebody that you can shop for outside of the bank's list of vendors, they can go up to whatever the price is. Okay. So if the bank gives you the vendor to pick, that price can go up 10%. If you pick somebody like, a different attorney, a different insurance company, things of that nature, that price can go up whatever they desire. All right, whatever you get charged. So again, this closing detail, these can never go up, this origination charge. Okay, 3 business days. Now, the closing disclosure that I was just showing you, you have to get a copy of that 3 days prior to the closing. 3 days prior to the closing, and it's got all of the fees and all of the changes and all the APRs and everything else. The same thing. It's just an extended copy of what we saw in the loan agreement. All right. So we cannot close until we've had this closing disclosure for 3 days. And as the agent, if you're the buyer's agent, you're responsible for the buyer side of this. As the listing agent, you're responsible for the listing side of it. You're going to need to go through it. Now, I know you're not going to know title charges, but you'll know if something doesn't look right. Yes, probably. You should. And then you can call somebody and say, hey, can you check this out? I don't think it looks right. Right? You can do that. So that is part of the closing disclosure. So when we look at this, when we do the closing details, right, we are going to look at prepaids, all of these things, right? This is the loan estimate. Hang on one second. Closing details. All right. Everything has got the appraisal fee was paid outside of closing. Credit report was paid by somebody else. So now some of it has changed, but not this top part, not the part that they said was 1802. And I think this was in the 600 range before on the original loan estimate. Now it's 236. So it's pretty much the same because this was paid, 405 was paid out somebody else. Inspection fees, title insurance, lenders. Now, as the buyer's agent, I'm going to be looking at these things. And I know a title search is normally $700 or $800. If I saw this and I saw $1,500, should I be making a phone call to the paralegal and saying, hey, can you explain to me why this title search was $1,500? Yeah, right? Yeah. Because that's your responsibility. You don't want your buyer to pay any more money than they need to. You have to check these things and you'll be held liable for it. Here is our recording fees here, right? Transfer taxes. This is your excise tax, right? This is your excise tax that we talked about. $1 per 500 or any part thereof. $180,000 sales price, $950. All right. And again, this is any state, but in our particular case, it would be what, $900. All right. Homeowners insurance. Now, your whole homeowners insurance is going to be due, and you have to pay that. Down here, we're going to see escrows. So we're allowed to do 2 months of escrow for the next payment. We got to start somewhere. So for the next time. So we're going to put 2 months of homeowners insurance and 2 months of property taxes. We have to pay those. All right. Prepaid interest. We have what? 15 days of interest that have to get paid, $17.44 a day. We're not going to get a bill here until June 1st for our April closing. So we got to pay the interest for April. The June 1st bill will be for May. Pay in arrears, right? We have to pay our property taxes that are due currently. Maybe 6 months are due. Right? HOA bills, capital contribution, processing fees, they all get added in here. The owner's insurance title policy is $1,000. Over here on this side, this is the seller side. You see that the real estate commission is over here on the seller side. So if I'm the seller, I'm looking at this form too, make sure this commission is split up right. Home warranty fee, I'm buying as the seller, I'm buying the home warranty fee. We split the inspection fees. Right? Notice that it is, we got a debit and a credit here. And so actually the seller paid for the home inspection fee. The last page or the third page, here's the comparative of what the loan estimate said. The loan estimate said that we would have to pay $8,000, $854. The final is $9,712 in closing costs. Okay. But you're going to see that that's going to come down because you're going to get a seller credit for $2,500 and we're going to get another adjustment, okay, for another $1,000 that's going to come down. So literally our final costs are less by almost $2,000 in our cash to close, okay? So it'll be broken down for you here. Here is a summary of their transactions. This is the borrower's transaction. This is the due from borrower, and this is due to seller. We're going to do a due from borrower. That's chapter 21. That's a big part of chapter 21, where we're going to figure out what's due from borrower to the seller. And so we'll do this as chapter 21. So deposit, $10,000. Loan amount, $162,000. Seller's giving them a $2,500 credit. They're getting a rebate from the tile company. All right. And this is all things that have already been paid on your behalf, right? If we get a loan amount, we get a credit. If we got to pay the bill, we have to pay the price of the house. That's a debit. We'll see that later. All right. Taxes have to be adjusted. This is all money that's due from the seller. Seller's got to pay off $100,000 in his loan, right? Got to pay his mortgage off. He's got closing costs too. He's got to pay the commissions off, right? He's giving the seller credit. His taxes he has to pay. Again, prorated, you notice, prorated. And down here, it's going to give us the cash to closing from the borrower to the seller, all right, to the seller. Page 4, can you assume this loan? Will not allow assumptions of this loan, right? Most loans now won't allow assumptions. They want to be qualify their lender. So in this particular case, they won't allow that. All right. It doesn't have a demand feature on there. All right. If they need early repayment of the loan. Negative amortization, we don't have to worry about. Over here, the escrow amount of money. The last page is where we want to go here. On the last page of the closing docs, If you make all of your payments, $165,000 borrowed, and we pay all of our payments, our 360 payments, for that 165,000 or 162,000, I'm sorry, we're going to pay $285,803.36. This is where most buyers clutch their chests in near heart attack. It is a big number, but that's over 360 payments. It tells you how much you're going to pay in finance charges, the whole thing, if you paid everything off in monthly installments, right? And then your amount financed. So technically, if you do all of this stuff, you're paying 4.174% interest, not 3.875. So they're giving it to you again, your APR. Notice this is down a little bit because your fees are down. And your total interest, if you look at 118,830, right? That is 70% more. This number 285,803 is 170% of 162. So 69.46. And that's what they have to give you. That is your closing statement. You have to get all of this information from them, every single one. If you bought a house recently, you saw this. Unless you paid cash for it, and then you didn't see one of these, you saw HUD 1, but it looks a lot like this. And this is the whole breakout for that. Okay. So again, we have to have that closing disclosure 3 days before the closing. If I don't get it 3 days before the closing, we cannot close. The attorneys are not allowed to close. So if it's 2 days late, we're going to push the closing back 2 days. We cannot settle before we've had that 3 days to review it. All right. And snail mail has to be 6 days before settlement. We don't usually use snail mail too much anymore, but if it's got to be mailed, 6 days. And these are all those tolerance limits that I talked about. 0 tolerance, the prices can't increase. Anything that's required to pay the creditor or the bank, any services to third parties that you can't shop for, and the transfer tax. Obviously, the transfer tax is not going to be able to go up. 10% on the recording fees and the unaffiliated third-party fees if you go outside and shop off of somebody else's list. But all these other things can have no tolerance. They can all increase. Escrows, you can add more. Property insurance premiums can go up. Prepaid interest can go up. You pay all you want on those, right? Services that aren't required, you can pay all you want on those. Those are not limited. Those are not limited. Okay. Any questions on RESPA? We're going to see some more in chapter 21. We'll get a little bit deeper. All right. Okay. Equal Credit Opportunity Act, ECOA. Equal Credit Opportunity Act. This says that you cannot discriminate against credit applications, all right, unless they do not have the ability to repay. So these are 8 protected classes. You can't discriminate on race, color, religion, national origin, sex, male or female, sexual orientation, gender identification. Can't discriminate on that. You can't discriminate whether they're married or not. You can't discriminate on age. And you can't discriminate if they're on public assistance. That does not matter. Okay? So these are protected classes. The only way you can discriminate is if they don't have the ability to repay. And that's it. Okay? So it doesn't matter. Now, 5 of these are part of the fair housing. The other 3 are added that are not in fair housing. Now, also, we have what's called the Fair Credit Reporting Act. And this gives you the right to check your credit report. You are allowed 1 free credit report every year. So if you're getting charged for a credit report, you're getting ripped off. You can get one for free every year. Okay? Just go out and look for Equifax or Experian or TransUnion and just ask for a free credit report. One of those 3. Those are the big 3. So if Credit Karma is charging you for a credit report, you're getting ripped off. All right. You can pay for one, but you can get one for free. All right. They're going to have the last 7 years of information on your credit report. Bankruptcies are going to be on your credit report for 10 years. All right. And according to the Fair Credit Reporting Act, you can get 1 free report every year. Every year you can get a free one. You do not want to mess around when somebody's going to, if you're playing with the bank and your client's doing with the bank, they had better be fair and honest. Do not mess with contracts. One contract going to the bank, another contract going to the attorney's office, okay? So loan fraud occurs when the buyer or borrower uses misrepresentation to obtain a larger loan than the lender guidelines will allow. If I'm paying $300,000 for a house, I send a contract into the bank that says I'm paying $350 for it. They base their 80% on that $350 versus the $300 I'm actually paying, and we both go to jail. And I am talking about jail. Okay, I'm not talking about fines. I'm talking about silver bracelets and everything. Okay, loan fraud is not anything to mess with. And the fines are huge. Truth is truth, right? We're going to go to the bank and we're going to give them the right things. We're not going to do anything. So in the way that happens is most often a buyer provides lender with documents containing false information. So the buyer can obtain a higher loan amount from than they would otherwise qualify for. We don't want to be part of that. We do not want to be part of that. It's just ugly and it just gets crazy. All right. So don't do that. All right. So that kind of finishes up chapter 15. And we talked about a few things in chapter 14 and 15. Blanket mortgages, where we buy land and we pay it back as we sell the house, right? If I got 20 acres and I sell my first house, I'll pay for the first acre. Second house, I'll pay the second acre, and so on. That's a blanket mortgage. PMI, private mortgage insurance, you're going to pay that if you're over 80%. Installment land contract is what? Seller financing, but the seller holds the deed until it's paid off, right? We just went through Regulation Z about trigger terms, right? If they give you any kind of number in their advertising, they have to give you the rest of the information. What's the APR? How much is your financing costs, things of that nature. Closing disclosure, we just went through, right? You have to get that 3 days before the closing. And it's up to the broker to make sure that their side, their buyer side or their seller side is correct or accurate, okay? You'll be held accountable by the real estate commission. And then the purchase money mortgage is just the opposite of an installment land contract in the fact that that's also seller financing. However, the buyer is going to get the deed at the closing. So instead of the seller holding the deed, the seller is going to hold a note. So if the seller has to foreclose with in a purchase money mortgage, they have to go to court to get their house back. In an installment land contract, they just have them evicted and keep the deed, right? Keep the deed. So that's the difference between those two. Both are seller financing. Mm-hmm. All right, thinking caps on here now. We got to cover 2 nights. True or false? After being foreclosed on by a lending institution, the lender has the right to file a deficiency judgment against the borrower. True or false? Yeah, they have every right to do that, right? Sure, absolutely. And same thing with short sales. Anytime you owe the bank more money, they have the right to come and get it. This clause gives the legal right to the lender to require full repayment of the loan once the borrower defaults. Full repayment of the loan. What is this called? This is the acceleration clause, right? Very good. Okay. Well, if you miss a payment, they have the right to call it and say, okay, you got to pay me the rest of the note and any fees that are due. Okay. So that, and they don't have to wait long. There's no set time. It could be one miss. Now, are they going to do it for one miss? Not if you talk to them, but you never know, right? This provision requires payment of the entire loan when the finance property is sold or transferred. This provision requires payment of the entire loan when the finance property is sold or transferred. Alienation, right? Due on sale clause, exactly right. There's our little, they say that's an alien. I say it's a rubber eraser. I saw erasers. Remember they used to go on the end of your pencil? You guys remember pencils, right? This little alien, it's the alienation clause, right? Bernard Buyer is borrowing $180,000 on the sale price of $225,000 for his new condo at North Hills. He wishes to pay 2 discount points of prepaid interest on the loan. How much will he be debited for this at closing? How much is 2 points? Now, remember this, it's always on the amount borrowed, not on the purchase price, right? It's on the amount borrowed. So he borrowed 180,000. 2 points is 2%. 2% of 180,000 is 3,600, right? 3,600. All right. True or false? Discount points are prepaid interest that increase the lender's yield and decrease the interest rate for the borrower. Yeah, that's the point, right? That's the point. This is true, okay? Even if I said, well, if you saw Rocket Mortgage, when we were doing Rocket Mortgage, they told you what the interest rate was going to be, but they also told you what you had to pay to get that interest rate. So what that points was that prepaid interest, because the rate is technically higher than that. So the investor is getting a higher yield. They got to get their money too. But if you want this rate, you have to pay those points. All right. So that is true. The formula for calculating loan to value ratio is what? How do we do it? We take I'll do this one with you. We take the loan amount and divide it by the sales price. Exactly right. Okay. Loan amount divided by the sales price, and that's going to give us our ratio. And this works either way. You can move this around. True or false? To be purchased by Fannie Mae, conventional loans are required to conform to the requirements set by the Federal Housing Administration. Yeah, absolutely, right? They have a bunch of requirements, and then it'll be purchased by Fannie Mae. True or false? Conventional loans are insured by federal agencies such as Fair Housing or Veterans Administration. On conventional loans, the lender bears all the risk. The bank is the risk taker. There's no insurance for that or anything else like that. When we're talking about Fair Housing, obviously doesn't lend money. Veterans Administration, they're going to guarantee the veteran repays the loan. FHA is going to ensure that the person borrowing is going to repay the loan. But that's the only guarantees or insurances that the bank is going to get. Everything else they absorb. True or false? The FHA will loan you money to purchase a home, providing you can meet the minimum 3.5% down payments to meet their standards. The answer is false, believe it or not. Because does the FHA lend money? The FHA does not lend money. The FHA ensures that the conventional bank can lend the money and that the borrower is going to pay it back, okay? So FHA and VA don't lend money, all right? But they're guaranteeing or they're ensuring that the borrower will pay it back from the commercial bank. Now, the commercial bank sets the interest rates. The commercial bank will set the any points that have to be paid. That's all directly out of the commercial bank, right? The FHA and VA don't set those things. All they do is insure, FHA insures, and VA guarantees. That's it. Everything else comes from the bank. Okay. In a purchase money mortgage, the buyer receives equitable title at closing and the deed once the debt is fully satisfied. True or false? Purchase money mortgage, they get the deed at closing. If the seller is going to hold the deed, that's an installment land contract. Okay, if the seller holds the deed, yes. In this particular case, the seller is going to receive a note for a purchase money mortgage, and they're going to give the buyer the deed at the closing, but not for an installment land contract. An installment land contract, the buyer is going to get equitable title, but the seller holds the deed until it gets paid off. Okay, that's the difference between the two. Okay, which of these is allowable advertisement based on Regulation Z? Number one, monthly payments start as low as $800 a month. Number two, seller will pay $2,000 in closing costs. And number three, own your own dream home in Chapel Hill with only a $3,000 down payment. Which one is allowable? Yeah, it's number two. There's no closing charges. There's no fees or anything else for the seller to pay you the $2,000 in closing costs, right? You're not borrowing that money. You're not borrowing that money.
If you like this video, feel free to share it with a friend. For more real estate education content, please subscribe to the channel. From all of us at Seacoast Real Estate Academy, thank you for watching.